Welcome to this explainer. I'm absolutely thrilled you're here today. I want you to imagine you just stepped into a masterclass, because today we're going to unpack the absolute backbone of business finance. We're talking about the single most critical financial document for any business anywhere in the world. Master this concept, and you'll understand exactly how successful businesses evaluate their performance and strategically plan for massive growth. Today, we're going to master the income statement.
Okay, let's dive right into our syllabus for today. First, we'll uncover the profit illusion. Second, we'll officially meet the income statement. Third, we'll break down revenue, expenses, and profit. Fourth, we'll look at some real-world business decisions. And finally, we'll wrap up with some AP exam practice. All right, let's get into it.
Section 1. The profit illusion.
So, I want you to picture something for me. Close your eyes for just a second and imagine that you own your absolute dream business. Whatever it is, just picture it. Customers are flooding in the door, sales are happening nonstop every single day, and your phone is practically vibrating off the desk because your social media is exploding with new orders. On the surface, everything looks incredible. You feel on top of the world. But then, someone taps you on the shoulder and asks one very simple, penetrating question. Did your business actually make a profit? Could you answer them? You know, it's crazy, but some businesses literally earn millions in sales and still manage to lose money. It happens every single year.
Let's say two students start online clothing stores. They both sell over 100,000 dirhams worth of products. Now, student A is absolutely celebrating, and hey, they should be. They brought in 100 grand and they only spent 70,000. That is fantastic. But then, well, there's student B. And I've got to say, I'm genuinely concerned for student B here. They also brought in 100,000 in sales, but they spent 125,000 dirhams to pull it off. So student A earned a healthy profit, while student B actually lost money, despite those massive sales.
Which brings us to Section 2. Meet the income statement.
That example perfectly illustrates why sales alone just don't tell the whole story. As business leaders, we've got to compare what we earn with what we spend. So let's lock in this crucial definition. An income statement is one of the three major financial statements used by businesses. It summarizes a company's revenues, expenses, and profit or loss over a specific period of time. Think of it as the ultimate diagnostic report card for your business. And unlike a balance sheet, which is just a snapshot on one particular date, this statement covers a stretch of time. Maybe a month, a quarter, or a full year.
Now, what's really interesting about this is how it distills everything down to its absolute core purpose. The income statement answers one vitally important question. Did the business make money? That's it. That is the bottom line, literally and figuratively.
Moving right along to Section 3, Revenue, Expenses, and Profit.
So how do we actually figure that out? It's incredibly elegant in its simplicity once you break down the pieces. Let's start with revenue. Revenue is simply the money you earn from selling your goods or services. If you run a bakery and you sell a bunch of cakes, that money is revenue. Clothing store selling jackets, revenue. A software company selling monthly subscriptions, you guessed it, revenue. But listen to me carefully here. Revenue is not profit. It's simply the money coming in. It's money earned, not money kept.
And the reason revenue isn't money kept is because, well, businesses spend money every single day. These are your expenses, and these costs directly eat into your profit. We're talking about common expenses like employee salaries, rent, electricity, advertising, insurance, raw materials, the internet, transportation, and equipment maintenance, the whole shebang. It takes money to make money, and let me tell you, these expenses add up incredibly fast.
So, the crucial point is this formula right here. Lock this into your memory right now. Revenue minus expenses equals net profit, or in some unfortunate cases, net loss. The revenue comes in, the expenses get subtracted out, and whatever's left over, that's your profit.
Let's look at this in action with a coffee shop example. Our coffee shop earns a wonderful 180,000 dirhams in revenue. Awesome, but we've got to subtract their expenses. Let's say rent is 30,000, salaries are 60,000, coffee beans are 25,000, plus your utilities, marketing, and all those other costs. Their total expenses equal 160,000. So we take that 180,000, subtract the 160,000, and boom, we are left with a really healthy net profit of 20,000 dirhams. Congratulations, the business successfully made money.
But now, let's look at another scenario, and this one's a bit tougher to swallow. A business brings in 100,000 dirhams in revenue. Great, but their total expenses are 125,000. The result? A net loss of 25,000 dirhams. The business spent way more than it earned. Whenever your expenses are greater than your revenue, you're taking a loss. And this absolutely proves that profit illusion we were talking about earlier.
Sales just do not equal success if the expenses are completely out of control.
All right, Section 4, real-world business decisions.
Listen, without knowing exactly where the money is coming from and where it's going, businesses are essentially flying blind. You just can't make strategic choices without the data. So who actually uses this information? The answer is basically everyone who matters to the life of the business. Managers use it to measure performance and reel in their expenses so they can increase profit. Investors absolutely demand to see it so they can evaluate the business, compare it to others, and decide where to put their cash. Banks lean on it heavily before they'll ever approve a business loan. And of course, the government uses it for tax purposes. Literally everyone relies on this document.
And this brilliantly illustrates why it's so useful. Let's look at a local restaurant analysis. In January, they had 250,000 dirhams in revenue and 210,000 in expenses, leaving a really nice 40,000 dirham profit. Excellent. But look at February. Revenue dipped just slightly to 240,000, but their expenses shot way up to 260,000. That resulted in a 20,000 dirham loss. By looking at this income statement, the owner can immediately start investigating. Why did expenses jump so much? Did food costs suddenly spike? Did a marketing campaign get way too expensive? This statement hands them the power to make better business decisions immediately.
Which brings us to Section 5. Time for some AP exam practice. Let's test your knowledge.
All right, you've absorbed some incredible information today. Now it's time to put on your thinking caps for some rapid-fire practice. I'm absolutely confident you're going to nail this. Here is question number 1. If a company earns 500,000 dirhams and spends 420,000 dirhams, what is its net profit? I'll give you just a second to calculate the math in your head.
80,000 dirhams. Yes, fantastic job if you got that right. You simply take the 500,000 in revenue, subtract the 420,000 in expenses, and there's your profit.
Okay, let's try one more. Question 2. Which financial statement specifically measures profitability? Is it A, the balance sheet, B, the income statement, C, the cash flow statement, or D, the budget?
The correct answer is B, the income statement. And listen, here is a massive, high-value AP exam tip for you. Do not confuse the big 3 financial statements. The income statement measures profitability. The balance sheet shows the financial position, like a snapshot in time. And the cash flow statement tracks actual cash movement. Keep those 3 straight, and you are going to be in excellent shape.
So, let's move forward and see how this builds into our practical takeaways for today. If you want to be a future entrepreneur, you really need to remember these 3 steps. Step 1, track every single dirham your business earns. Step 2, record every expense accurately. And Step 3, review your income statement regularly so you can make smarter business decisions. Remember, revenue creates the opportunity, but meticulously managing your expenses, that is what actually creates the profit.
I want to leave you with this final, provocative question to chew on today. Would you rather run a business with high sales and low profit, or lower sales with higher profit? And more importantly, why? Think about your strategy. Discuss it with your peers. Thank you so much for joining me to master this explainer. Keep analyzing, keep learning, and I'll catch you next time.